Today's Talk About It Tuesday question is, how will the presidential election affect the stock market? All right. I like this question, and I actually get this question quite a bit. And people want to start planning now, since we have an election coming up in November. What should I do with my money? Now, I have to say this as a disclaimer. Past performance is no indicator of future performance. Now, having said that, I'm going to show you how I geek out on financial data. All right. So I looked at every presidential election year from the 1920s up until the last, so for about 100 years. So let's say I looked at 100 years of data in terms of presidential elections. And there is a trend around the stock market, right? So there's a trend. But let me say this. There are a couple of outlier years that we have to remove because it skews the data. So if we look at the election that occurred during the Great Depression, which was in 1932, and if we look at the two elections during World War II, right? So if we look at 40 and was it 40 and I think 44, right? 40 and 44. And we look and we take out the tech bubble in 2000, and we take out the Great Recession in 2008, that election year, and we take out the COVID year because that was like a recession, even though it was kind of, man-made because of, well, not even man-made, it was COVID related. So it acted as a recession in 2020. If we take out those elections, which will skew the data, we see a pretty consistent pattern on how the stock market performs in a presidential election year. So in most cases, the year leading to the election, and the closer to the election we get, we see this trend even greater. We see volatility in the market and a lower performance because of the volatility. In the year following the election, we see almost the exact same thing. And so the years outside of an election year are consistently less volatile and more steady in terms of what the returns are. So what does that tell us? If we exclude major economic issues, then it's not the economy, right? Because we know there are economic factors that will affect the stock market. But excluding those things, if we look again at the average, what does that tell us? That there is uncertainty in investors around an election year. Listen, you don't know exactly who the president is going to be. You might align with the values of one president and not the values of another in terms of their economic policy. You might be a little worried about how the economy is going to go. So that's why we see this volatility. And they make campaign promises that you're uncertain of. And then, right, that year following, maybe they don't really follow the campaign promises. Or maybe there's still that uncertainty in that year, that first year. Now, there is a difference between an incumbent president being elected and a new president being elected, right? In the incumbent president, there's a little less volatility. And again, that just goes back to the uncertainty or less uncertainty because you pretty much know what you've gotten, right? You've had this person 4 years and you know what you're going to get pretty much a repeat in the next 4 years. So what does that tell us? Even though we're seeing a slight upward trend because of economic factors, there's slightly more volatility in the market, right? And it's pretty consistent right now leading up to the election. And we'll probably see that no matter who gets elected in the first year, because we don't have an incumbent president this time, right? So we'll probably see that volatility because of the uncertainty until we get a handle on, okay, what are the economic policies, what are the tax policies, what are regulatory policies move for different companies moving forward. Once a lot of that is established in that first year, you'll see the stock market become much more stable as confidence either goes up or down. When I say stable, it could be stable down, it could be stable up, but we'll see that trend be more steady as opposed to the volatility a year after the second year of the new presidency. So that's historically what has happened. But again, the past is not necessarily an indicator of the future. It could be totally different, right? We're moving into a totally different age where technology has changed a lot of things, where the political divide has changed a lot of things. Like, we don't really know. But if we go all the way back to the 1920s, that has been the trend. So, like I said, it's just kind of nerd stuff. But you shouldn't do much differently than you have been doing in terms of your investing strategy. Because you always want to fight volatility by being well diversified and things like that. So I'd love to hear your thoughts on the economy, well, not even the economy, the stock market, what you think it's going to do. If you think it'll be vastly different if one president gets elected over, or one candidate gets elected over the other. What are you going to do to prepare for that? But please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.